capital gains, though perceived a little negatively because it's gone up a little bit, is actually going down the path of simplification.
When in 2004 STT was announced, it was announced as a replacement of in exchange of the long-term capital gains tax. Now we have both at an increasing rate in this budget, right? So that seems a little unfair to me.
Hi everyone, I'm Avni Raja. Over the next couple of hours, we're going to take you through the budget announcements. A lot of it has come in, and as far as the taxpayer is concerned, with regard to the new tax regime, with regard to long-term capital gains, and in some disappointing news, the long-term capital gains has been hiked from 10 to 12.5%. Some other announcements have also come in which impact your wallets. So what we're going to try and do is, over the next couple of hours, we'll have a whole host of experts who will join us and who will try and break it down, what Finance Minister has said, and most importantly, how all of that is going to impact your wallets, your investments, and your money. So let's start off. We've got a host of guests joining us who are with us at this point in time. First up, we've got Vishal Dhawan. Vishal, thanks so much for joining in. First off, your biggest takeaways from the budget. What do you think has been the biggest in terms of the impact on taxpayers?
So thank you for having me. So I think the biggest thing has clearly been this whole, conversion of a lot of what was being talked about into actual implementation. And I think there's clearly simplification that seems to be the path forward. You can see how capital gains, though perceived a little negatively because it's gone up a little bit, is actually going down the path of simplification, because you now have standard definitions of long-term and short-term. You have rates that are getting standardized. You have indexation that is getting sort of removed. So I think it makes it much simpler for taxpayers to compute what their actual tax is, and therefore avoid errors that come simply because people are misinformed. The second big thing is clearly the fact that there is an intent to try to put a little bit more money into the hands of taxpayers through some of the tax reductions that have happened, and very, very focused around the new tax regime. I think the intent has been there to actually get people to move towards a new tax regime. And in every budget, you're continuously seeing that one more step being taken. For example, the standard deduction increase from 50,000 to 75,000 is only available under the new tax regime. And lastly, I think that continues to be focused on moving investors thinking longer term rather than shorter term. So you are seeing some increases in rates on ST, on FNO. You are seeing short-term tax rates being increased on capital gains. You are seeing interest deductions getting better tax breaks to save towards your longer-term retirement. So I think there are broadly three big themes that we are carrying away from the budget.
Right. Kanan Bahl is also joining in. Kanan, thank you for joining us as well. Your takeaways from the budget, because obviously, like Vishal was saying, there is a clear attempt to, on one hand, try and curb the speculative, aspect which the market has really overheated over the past few months. And the other hand, it is to try and sort of give people more money in hand, which we're seeing with a hike in the standard deduction, a rejig of the tax slabs of the new scheme, though.
Right. So, Avni, thanks for having me. So I'll just give my, candid feedback about the budget, especially as far as the equity markets are concerned. You see, when in 2004 STT was announced, it was announced as a replacement of in exchange of the long-term capital gains tax. Now we have both at an increasing rate in this budget, right? So that seems a little unfair to me personally. And second, if you look at the capital gains tax on real estate transactions as well. So if you look at the plight of people whose projects were stuck and they had been paying interest, and all of their capital would have eroded to a significant level, but they would have taken the benefit of indexation and saved themselves today when the properties have finally, after IBC and a lot of other initiatives, come in their control. But if you look at it, say for example, they purchased the property at 60 lakhs, the index value is 90 lakhs. If they're selling it today at 1 crore, they would have paid tax on just 10 lakhs, but now they'll have to pay tax on 40 lakhs at 12.5%. So that to me seems a little unfair to the real estate investors or to the real estate investors as well. And apart from that, as far as the gold investors are concerned, they have a reason to rejoice, but their indexation benefit has also been taken away. That is one. And second is that their existing holding would be reduced by around 6 to 7% today, because the customs duty has been reduced on gold.
That's right. Right. So, Vishal, now coming to how investors should approach, because the capital gains increase is going to be retrospective as far as this financial year is concerned. So, even if somebody has sold off something in the last couple of months, they will still have to pay the 12.5% long term capital gains. So, what is the advice now as far as investors are concerned in terms of any change in strategy? Obviously, because the tax is going to be higher.
Seems reasonably clear from the fine print that tax is going to come on a prospective basis for all transactions that happen July 23rd onwards. So unless an investor has done something this morning before the budget, I don't think there is a retrospective tax that really applies. Having said that, it is a important thing to sort of distinguish what really happens in equity. So I think the government has always held a view that equity markets are a place for capital formation, and it's a way for creating long-term wealth for investors. And I think anything that happened which was shorter term was largely looked upon as speculative activity. Either if you bought positions in futures and options, or you even bought and traded stocks or mutual funds, which was happening quite significantly. So I think what this is trying to do is trying to address this anomaly that a long-term asset class is being treated as a speculative tool because the gap between tax rates is not significant enough. And I think what has happened in this project is clearly this gap is being increased. So earlier the short-term rate was 15, long-term was 10. Now long-term becomes 12.5, short-term becomes 20. So this gap, which was 5%, becomes 7.5% going forward, making it that much more important for investors now to really think whether they want to be thinking short-term and long-term. And I suspect that this is the start of what's going to continue to happen in future budgets as well. So this gap of 7.5% might actually keep increasing going forward. And therefore, equity as a vehicle will now truly start to get looked upon, at least as a one-year vehicle. Ideally, even 1 year is not good enough as far as equities as an asset class is concerned, but at least that journey has begun. I think what investors need to do here is, not get very sort of carried away by this capital gain tax rate. I think taxes are what you end up paying when you make some money. So the focus continues to be for all investors that how do we ensure that as capital market investors, we continue to make money on our investments. And towards that end, you can clearly see that there has been one big concern that a lot of people had, which was, will the mandate from the elections result in fiscal, prudence being given up? And I think that was probably for me the biggest benefit for the stock market, which came through, which was that there is a fiscal path that is going to continue to get followed. The objective is here, FY25, 4.9%. FY26, 4.65%. And there was a clear statement from the finance minister that this glide path to reduce deficits will continue, which means that from a longer term perspective, equity investors actually gain from prudent fiscal management.
Right. Right. Kanan, coming to you here in terms of the new slabs that have been announced for the new tax regime. Over the last, since the new tax regime has been announced, we haven't seen too many people really opting for it for a variety of reasons. And every year, the FM has done something to try and make it more, try and encourage more people to adopt the new tax regime. In your view, is this now going to be that additional incentive for people to opt for it?
Right. So if I go back to the history, then it was in 2020 when the first new tax regime slab rates were announced, and they were pretty unattractive. So the government got it and they changed it in 2023 to almost these kind of rates, which have been further rationalized and made more lucrative for the investors. So, like the FM said in her speech as well, that a lot of investors, I can't exactly recall the number, but I think it was around 2 to 4 crores, somewhere between that, have opted for the new tax regime, which is good. I might also be ending up opting for the new tax regime for my last fiscal year IT return, right? Uh, so that's one thing. And second, if you look at it now, they have not only increased the slabs, which will lead to a benefit of 17,000 up to 17,500 for the taxpayers opting for this regime. There are two major benefits that only new tax regime uh, those who opt for the new tax regime will stand to benefit around. One is the standard deduction that has been increased from 50,000 to 75,000 rupees. So
Right.
definitely earlier, if your income was up to 7.5 lakhs, you were tax exempt. Now that has been increased to 7.75 lakhs. So definitely the more the merrier, right? For these kind of deductions for the taxpayers. So essentially, technically, your non-taxable income bracket from your salary is now increased to 7.75 lakhs. Second is the NPS. Now, typically, to 10% for private employers, I'm saying, up to 10% of your basic salary that was contributed by your employer towards their contribution, employer's contribution to the NPS was exempt. Now this has been increased from 10% to 14%, and I see this as a very good step. Because if the government is promoting schemes like NPS, then it's a very good decision in the favor of the larger investing community. Why I'll tell you is because we typically chase returns. So people say that ELSS will make you 2x money than PPF, then why invest in PPF? But the problem is only 3.5% people stay invested in mutual funds beyond a period of 5 years, right? So we essentially forget that it's the time period that's most important in investments, which instruments like PPF, EPF, and NPS help investors stay invested in. So this is one good. While I am myself a mutual fund investor first, but this will definitely help a lot of investors in their retirement planning and incentivize them towards that.
Right. Right. Vishal, in your view, is this going to now incentivize more people to opt for the new tax regime? Because the finance minister has said that about 17,500 rupees will be the savings for a salary taxpayer, and of course, the standard deduction also being increased and the slabs being tinkered with.
I think it'll definitely create more awareness because there is, we still think that not enough people are aware of, the fact that there are two tax regimes that they sort of need to opt for. And of course, last year itself, they've sort of created a default tax regime from this year onwards. So I think there is every step being taken. It's going to be a gradual process. But I think more and more people are going to opt for the new tax regime, or at least very seriously think about it if they don't have a lot of other deductions that they are taking advantage of. The one other thing that I think comes as a default sort of action is that there has been a lot of focus around job creation, and you can see a lot of announcements around that space, from education incentives to internships to giving benefits to first-time employees, to employers, etc. And ultimately, the more number of people who come into the workforce, the better it is for actually income creation. And therefore, a lot of these people will consume, will have savings, will opt for tax regimes, will invest. So I think some of the larger term implications of this are very, very significant. And therefore, I would say that tracking how this whole chain works, where you get MSMEs to hire more people, they go out, get higher incomes, then they go out and consume, they go out and save, they go out and invest, they do all of that, is probably what really long-term growth will come from, and where really long-term growth will come from. So I think that new tax regime needs to be looked at in the context of this new taxpayer also coming in the future. This combination is a great combination.
Right. Kanan, do you believe somewhere that schemes such as the ELSS are going to end up losing sheen as we go forward? Because not only has ATC not been increased for a long time, it's such a crowded section there's no space left for any additional investments as well for most people. So ELSS was, in a lot of demands a while back when before the new tax regime came up. So now going forward, we're going to see more and more people moving to the new tax regime, and as a result, we'll see all of this ELSS type products lose sheen.
In my view, yes, it will definitely be at effect because people, it's a smart way of government to make people invest in their favor only by giving them tax breaks. Now, since that tax break has been removed of as far as ELSS is concerned, then definitely I believe that in my personal view, yes, ELSS will stand to lose around like what it used to be earlier for investors. Definitely.
Right, right. Right. And Vishal, so now going forward in terms of, the new tax regime, in terms of how people approach the old regime, your thoughts, because my initial hesitation with the new tax regime was only that it's going to stop people from investing, because the ATC or the old regime forced people to make those investments to save that tax. The new tax regime, it's all voluntarily. So that was my biggest issue as far as the new regime was concerned. But your thoughts now, as we sort of look to probably going to see the old regime being phased out eventually.
Well, it's definitely a concern because there was a very large section of the population who just invested simply because there was a tax break associated with it. I think here's where a lot of self-discipline is going to be very, very important for investors. And the simple way to solve this for a lot of them is going to be that, when they get their salary credited, that SMS hits your mobile phone. I think that day or the day after, they have to set up a fixed amount that gets invested every month. Whether they do it through an SIP, whether they do it through a recurring deposit in a bank, whether they do it through any other method which is investment oriented. I think that discipline is really important. And I think what the tax regime changes have done is essentially moved the onus from the government to the individual or the family, saying that, you got to take ownership of what you got to save. And I think the moment you do that, it now is really, really important that it's automated, because if you don't do it in an automated manner, it's not going to happen. And we saw that even with the tax savings that investors used to do, that there used to be a lot of crowding that used to happen between the Jan to March quarter, because that's a time where everyone was forced to do their tax savings. I think the discipline that hopefully more and more investors will be able to see going forward is you start off at the start of the financial year, or if you have a full budget like this year when it comes only in July, you start right away and you actually plan to do your investments even if it doesn't save your tax, at least to the extent that you have done in tax saving instruments. I think that's really important for investors to put in place.
Right. Vishal, are you happy with the way the changes have come in as far as trying to rationalize the capital gains structure? Of course, it has been in the works. We've been expecting something or the other, but the way it's being done, the process that they're using, is that something that works, you feel?
So I think there are two things that are happening as far as this is concerned in our view. One is that there is a simplicity in terms of definition of holding period. And I think that's important because it's very confusing for investors if, equities long-term definition is 1 year, real estate long-term definition is 2 years, gold long-term definition is 3 years, debt mutual funds, there's no real definition of long-term at all anymore. So I think it was very complicated when you have differing definitions, because if you met someone, you didn't know how to answer that question unless you got deeper into detail. I think they've tried to simplify it by saying there is only long-term, which is 1 year, and short term, which is only 1 year, and long term, which is 2
Yes.
years for all other assets except for equity. So I think that path of rationalization is starting to happen clearly. The second thing that they're doing is, again, the path of rationalizing and equalizing rates. So what you've done now is for long-term assets, you've already equalized to 12.5% by bringing down rates on real estate, by bringing down rates on gold, and simultaneously bringing up rates on equity. What has been done on gold and real estate is the indexation benefit has got removed. And as a result of that, you may not actually end up saving tax. Depending on when you bought those assets, you could actually end up paying more tax than what you paid earlier, or maybe equal tax or less tax. So that depends on when you invested in these assets. At least it's again getting simplified to become one rate. And last but not the least, what you're also doing is you're saying that I do want to try to increase the differential in tax rates between short term and long term as well. So therefore, for a lot of investors who are especially in higher tax brackets, that difference, which is there, and even those who are in lower tax brackets, is an important determinant on how they act. And I think what you're doing is messaging coming out from some of these is actually saying that, hey, why don't I promote longer term investing by making the difference, for example, 7.5% between short term and long term against 5% that it was earlier. I think there is a nudge which is happening here towards longer term investing. And I think that's good news. And I suspect that one of the reasons why investors may take a little bit of time to digest this is because the most obvious reaction is it has gone up. But it has gone up in places more where the sort of action should be not to be in that space. So short term going up is actually good news, not bad news from a long-term investor point of view.
Right. And the long-term capital gains, the exemption limit has also been hiked from 1 lakh to 1.25 lakh. So clearly they're trying to protect that, as a small taxpayer, so as not to have him bear the burden of, the higher tax rate as well.
Absolutely. I think that's an important point that they're not taking away exemption limits completely. They are trying to sort of increase that a little bit. Though to be fair, this is just an inflation adjustment that's happening because this came in a few years ago, and just the value of 1 lakh rupees at that point has probably gone up to somewhere close to that number today. But yeah, I think investors will take what they get at this particular point.
All right, Vishal, we leave it there. Thank you so much for taking the time.